Imagine wanting the NASDAQ 100 growth engine, the same basket driving NVIDIA, Apple, and the rest of the big tech names, but with a serious monthly income check instead of waiting years for price appreciation alone. That's the exact trade XQQI is built to make. It sits in that derivative income lane where the fund owns the stocks and then layers options strategies on top to pull cash forward. The question is whether the machine actually delivers durable income without quietly shrinking the engine underneath. XQQI is the NEO's boosted NASDAQ 100 high-income ETF. It launched on January 29, 2026, so we're still looking at a young fund with just over 5 months of live history as of July 9. The official description is straightforward. It mostly invests in large-cap equity and actively uses stocks plus options on the NASDAQ 100 index to target tax-efficient high monthly income. The tools it reaches for are call spreads and covered call strategies. In plain terms, the fund holds a concentrated slice of the NASDAQ 100 names and then sells options against that basket to harvest premium. That premium becomes the fuel for the monthly distributions. Because the underlying is the NASDAQ 100, you're getting heavy exposure to technology and growth stocks. But the options overlay changes the payoff profile in ways a plain index fund never does. This is not financial, investment, tax, or legal advice. It is not a recommendation to buy, sell, or hold any security. ETFs can and do lose value, sometimes sharply. The numbers we discuss come from publicly available data as of July 9, 2026, and distributions can change. Always read the current prospectus, fact sheet, and tax documents yourself, and consult a qualified professional who knows your full situation before making any decisions. Right now, the net asset value sits at $50.80. Assets under management are $216 million, which is modest but growing for a fund this new. The expense ratio is 0.98%, which is on the higher side for an equity ETF and matters more when returns are being pulled forward through options. It pays monthly, which is the feature most viewers notice first when they scan the ticker. The headline distribution yield is listed at 10%. That number gets attention, but the mechanical annualized figure based on the latest payment comes in at 21%. The most recent distribution was 88 cents per share. The average of the first 4 payments was 82 cents, and the average of the latest 4 sits at 86 cents. The trend has been roughly stable so far. What that means in practice is that an investor buying at the current net asset value is looking at a payout rate that feels elevated relative to plain equity yields. But the stability of those payments will depend on how much of the cash is coming from actual option premium versus other sources. High headline yields on options income funds often look great on a screen until you watch how the net asset value behaves over a full market cycle. Because the fund is only 5 months old, the distribution history is short, but the pattern across the payments that have been made shows consistency rather than wild swings. The averages moving from 82 cents early on to 86 cents recently suggest the income engine has held steady even as the underlying NASDAQ 100 names moved around. That stability matters for anyone counting on the monthly check to cover living expenses or reinvest. What we don't yet know is how the payout will behave when the options market gets expensive or cheap, or when the underlying stocks go through a prolonged sideways or down period. Early stability is encouraging, but it is still early. The launch reference price was $47.51. The net asset value has moved from that starting point to the current $50.80, which translates to a 7% return on the price path alone. Along the way, the fund recorded a maximum drawdown of 14%, which is a reminder that even with an income overlay, the share price can still drop when the NASDAQ 100 corrects. The net asset value path tells part of the story, but the real test for these funds is whether the price recovers after those dips or whether the income generation starts to compete with capital preservation. So far, the price has made net progress, but the 14% drawdown shows the equity risk is still very much present. When you add the cash distributions of $5.09 per share since launch, the simple distribution-inclusive return reaches 18%. That is more than double the 7% net asset value return, which illustrates how much of the early performance has come from the payouts rather than price appreciation. For an income-focused investor, that split can look attractive. For someone who cares about total wealth compounding, the gap highlights the classic tension. Money is being delivered in cash each month, but less of it is staying inside the fund to grow. Over longer periods, that difference compounds, which is why the total return figure is the one worth watching alongside the headline yield. Here is where the machine actually works. XQQI owns a basket of large-cap NASDAQ 100 stocks and then overlays options to create the income. The top holdings include NVIDIA at 7, 65%, Apple at 7, 26% Micron at 4, 87% Microsoft at 4, 70% Amazon at 4, 23% and Advanced Micro Devices at 3, 77%. Those 6 names alone make up more than 32% of the fund. The strategy uses covered calls and call spreads on the Nasdaq 100 index. A covered call means the fund owns the underlying stocks and sells someone else the right to buy them at a higher price by a certain date. The buyer pays the fund a premium upfront. If the stocks stay below that strike price, the fund keeps both the stocks and the premium. If the stocks surge past the strike, the fund delivers the shares and forgoes some of the extra upside. Call spreads work differently. The fund buys one call option and sells another at a higher strike, collecting a net premium while capping both the cost and the potential gain. The premiums collected from both tactics are what fund the large monthly distributions. The trade-off is built in. In a strong, steady uptrend, the fund will lag a plain Nasdaq 100 tracker because some of the rally gets handed to the option buyers. In a volatile but range-bound market, the premium collection can shine. In a sharp sell-off, the equity holdings still drop, though the premiums provide a small cushion. Because some distributions can include return of capital, the net asset value can erode even when the market is flat. That is the income now versus growth later bargain the fund is making. From here, watch three things closely. First, how the option premiums behave as Nasdaq 100 volatility rises or falls. Lower volatility usually means smaller premiums and more pressure to maintain the payout rate. Second, whether future distributions stay fully covered by premium income or begin to rely more on returning capital, which would show up in slower net asset value growth over time. Third, how the 0.98% expense ratio interacts with the strategy in different market regimes. That cost comes out every year regardless of how much premium the options generate. Also compare the fund's path against a plain Nasdaq 100 ETF during the next meaningful tech rally or correction to see how much upside is actually being traded away. XQQI turns the Nasdaq 100 growth story into a monthly income stream by selling pieces of the upside through call spreads and covered calls. The early record shows solid distributions that have stayed roughly stable, and a net asset value that has made progress even after a 14% drawdown. The cost of that income is visible in the gap between the 7% price return and the 18% total return, and in the possibility that some of the cash flow trims the fund's own capital base. It suits investors who want the tech exposure and are willing to accept capped participation in big rallies in exchange for the cash flow. It does not suit investors who need every dollar of upside or who are uncomfortable with options mechanics and the higher expense ratio. The fund is still young, so the real test will come when the options market and the underlying stocks move through a full cycle rather than the first few months of existence. Two quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next? And where do you think the real risk is hiding? We read everyone. Thanks for watching.